Hello, this is Paul Gibson with the Academy of Trading and Investing. We're here once again to examine how to determine bull markets versus bear markets. This is a technical analysis tool or just a way of looking at charts to help us understand which direction the market is going to go. These are great predictive tools. Let's define a bull market. A bull market is the condition of a financial market of a group of securities in which prices are rising or expected to rise. The term bull market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, commodities, and anything else. Because prices of securities rise and fall essentially continuously during the trading period, the term bull market is typically reserved for extended periods of time in which a large portion of the security prices are rising. Bull markets tend to last for months or even a few years. Well, conversely, what is a bear market? A bear market is a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Typically, bear markets are associated with declines in an overall market or an index, like the Standard & Poor's 500. But individual securities or commodities can be considered to be in a bear market all on their own, as they experience a decline of 20% or more over a sustained period of time, typically 2 or 3 months or more. Now, bear markets can last a little bit less time than that, but generally speaking, we're looking for something a little longer. The U.S. major market indexes fell into bear market territory on December 24, 2018. The last prolonged bear market in the United States occurred between 2007 and 2009, during the financial crisis, as we tend to call it, and lasted for roughly 17 months. The S&P 500 lost 50% of its value during that period of time. Bear markets tend to be short-lived compared to bull markets. Bull markets tend to be much more elongated but less aggressive, whereas in a bear market, the market tends to fall rapidly in a shorter period of time but then recover more quickly. So let's take a look at some indexes. As you may know, the Russell 2000 index is a conglomeration of the values of 2,000 stocks on the New York Stock Exchange. We can see quite clearly here that we had a bullish run here with some bearish adjustments along the way. And each one of these candlesticks is a monthly candlestick for this period of time. Once again, bear markets tend to be shorter but more dramatic than a bull market. Let's take a look at the Standard & Poor's index for the same period of time, the S&P 500. Once again, we have a bullish run here with a nice run up here, then a bearish function coming along. These are monthly candlesticks, followed by another bullish run, a bearish adjustment, and then continuing on as a bullish function with a couple of bearish adjustments going forward. Let's take a look at the Russell 2000 for a 5-year period of time. These are monthly candles. As you can see, in this case, we have 2 monthly candles here that indicate the beginnings of a bear adjustment. Once again, 2 bear candles with a doji at the end. The doji, as you may recall, represents a potential pivot point or change point. Sure enough, that's followed by this bullish function. We get an occasional bearish adjustment, but generally speaking, we're in bullish territory till once again we get those 2 monthly candlesticks indicating bearish intervention. Here's the same period of time for the Dow Jones. Once again, we can follow this right along. A doji here with 2 bearish candles. Here's a bearish adjustment, followed by a long bullish candle, doji, bearish adjustment, doji, then continuation on as a bullish function here. It seems like when we get those 2 bear months combined, it puts us into a little bit of a bearish tailspin for a while. Here's the Standard & Poor's for the same period of time. Once again, we get these functions coming along, following the same patterns of bullish candles and bearish candles. Dojis are pivot points. See a few of those along the way, but mostly bullish function with an occasional bearish adjustment. So we learn to read these candles. We become very astute at being able to predict which direction the market is going to go in the future. Here's a comparison of the indexes, the Russell 2000 versus the Standard & Poor's 500 index. The Russell 2000 is in blue, the Standard & Poor's is in gold. We see that these markets, or these indicators, tend to shadow each other. And of course, we would expect that the S&P 500 would be a little more volatile with a little more dynamic price action than the Russell 2000. Once again, we're going to compare the S&P 500 to the Dow Jones. The Dow Jones is in blue, the S&P 500 is in gold. Because the Dow Jones Industrial has fewer stocks, we expect to see a little more volatility, a little more price action there. And here's the S&P 500 for 6 months using daily candles. Once again, when we see two bearish candles together, we would expect that that would take us into a bearish period. And we have some recovery back over here. Here's the S&P for 3 months using daily candles. Two bearish candles leads us into a bearish function for a period of time. Sideways action here. Then we get a recovery. Two bearish candles. And once again a recovery. We're going to now compare an individual stock, in this case General Electric, to the S&P 500 index. GE was one of the S&P 500 stocks, and it followed pretty well along with the index until we had some bad news here. There was a change in leadership, and also the company began to sell off some assets, trying to recoup perhaps its financial position, which only caused heartache with the investors. The stock price continued to go down. This is a great example of how a stock can become what's known as a contrarian stock. It's acting contrary to the normal market index. Here's another example of a contrarian stock. The S&P 500 index is represented by this gold line. In this case, Tesla has an incredibly bullish run, contrary to the rest of the market. Nevertheless, a nice run up in stock prices for Tesla. If we'd been watching this back here, we could have made a lot of money with Tesla over this period of time. So now let's add some simple moving averages to help us identify these periods. So we're going to add moving average of 20 days, moving average of 50 days in red, moving average of 200 days in green, the 20 days in blue. If we can look at these moving averages, we might be able to identify a time when we're entering a bearish function. So as we see here, there's a crossover of the 20-day going from above the 50-day to below the 50-day. We get a confirmation on the MACD here that we're in a bearish function. And sure enough, the stock prices continue to go down. In this case, we can get a death cross, which is where the 50-day moving average crosses over the 200-day moving average. That is known in the market as a death cross, which means we're entering definite bearish territory. And sure enough, it's confirmed that we're in definite bearish territory for quite a period of time, confirmed with the MACD. And of course, the stock prices continue to go down. We get a little bit of recovery back over here, but it takes a while for us to get that confirmation that we're back in a bullish market with the crossover of the 50-day going above the 200-day in this particular area. We're getting back to more of a bullish function. Here we're going to take a look at some simple moving averages from December 31st, 2009 to December 31st, 2011. Once again, the 20 day is in blue, the 50 days in red, the 200 days in green. I get a crossover here. 20-day moving average coming above the 50-day moving average. This would indicate a bullish period. That continues on quite a while until we get over here, and perhaps we get back into a bearish function or confirmation. We like to look at the candlesticks, however, because the candlesticks can give us a little bit of a heads up before those moving averages cross over each other. We can be prepared a little bit better when we see those two bearish candlesticks. Here's a little bit of a confirmation of a potential bullish continuation. Then once again, we have that bearish confirmation being reversed by a bullish confirmation, the crossovers. Once again, this is Paul Gibson with the Academy of Trading and Investing. We've enjoyed being with you here today. We hope that you've learned something and your capacity to be able to predict stock price movements in the future has been enhanced. We encourage you to take greater interest and study more at the www.academyofti.org or Academy of Trading and Investing. If you have more questions, let us know. We'll be glad to help you. Also, the book Notes from a Profitable Investor, How to Invest in the Stock Market, are now available also on Amazon.com and on Kindle Reader. We'll look forward to talking with you another time. Good luck with your investing. Let us know if we can help.